Hey, real life traders from all over the world. This is Jerremy Alexander Newsome with Real Life Trading, and I hope you're doing absolutely sensational. Want to make you another very popularly requested video, and it's regarding day trading and option trading and combining the two to make one beautiful marriage of money making opportunities. What's interesting with option day trading is what most people skip over when learning about option day trading. The number one thing that most people skip over is actually learning how to day trade first, right? Most people just go in and they think, oh, okay, I'm gonna start day trading. I'm gonna go into this particular stock. They go look at the stock. They pull up the hourly chart, right? Looking at Allegiant Technologies, and they see these moves. They see the opportunities, and they're looking at the candles and they say, wow, if I had just bought here and sold here with a weekly option, I would be making a killing right now. And absolutely, without question, weekly options are a phenomenal way to make money very, very quickly. The issue with weekly options is that the majority of traders who use them, I don't know if the majority is the right term, but I would say a lot of people who use weekly options go in understanding numerically how much money they can make in the weekly option trade, but they do not understand first the trading plan or actually day trading and how to get an edge and how to actually day trade a weekly option. So there's a lot of ways to trade weekly options. If you are trading a weekly option and you want to use a weekly option, if you are buying a weekly option, and let me kind of define a weekly option. A weekly option is any option with less than 2 weeks of time. With less than 2 weeks of time. That's the way I'm going to be defining weekly options in this specific video. Now, if you're looking at the Chicago Board of Options Exchange, any option that's expiring on a non-monthly expiration, meaning, for example, March is coming up. So March 23rd, the third week of March. I don't think that's the 23rd. Give me 1 second. March 20th, okay? That's the third Friday of March. So on March 20th, that's a regular monthly expiration. Well, some people will say a weekly option is any option at all that's just simply not expiring on the regular option expiration date of the month, which theoretically is true. But when most people refer to weekly options, what they're referring to is buying or selling an option that expires within a week or approximately a week of time. That's usually what people refer to as a weekly option. So if in this exact video, a weekly option is any option less than 2 weeks of time. That's going to be my specific definition, just kind of give you guys an understanding, an idea of a little bit about what I'm referring to, okay? So here are my thoughts. If you are buying a weekly option, you need to be day trading it. Day trading it. You should only hold a weekly option overnight if it has more than 1 week to expiration. And here's the interesting part. And you are playing with house money. Now, what in the world does that mean? Let me give you an example on Apple. And I'll specifically let you know why Apple is the example that I'm looking at in just a few moments. But let's look at Apple in regards to what I just mentioned a moment ago. If you are trading with house money, what does that mean? Well, let's say today on Apple, you were looking at the hourly chart. So here's the hourly chart on Apple, and you notice that, okay, this is a nice little retest gap on the hourly. There's a white candle gapping up. It's a retest gap. Okay, cool. So you come into the 15-minute chart, looking at the 15-minute chart, and you play this breakout right here. Here's the breakout of the pennant pattern. You get in bullish at 131, your stop is 131.43, and you exit your options up here at 132.60. And that's the trade that you take. And you say to yourself, okay, awesome, I did great, I'm super, super excited about it. But in this particular trade, you bought an option that has more than a 1 week to expiration. So you didn't buy February week 4, but you actually bought March week 1. Okay, March week 1 expiration. So this is, again, more than 1 week to expiration. and you're playing with house money. So what that means is if you had bought 4 option contracts, and you sold 3 of them, I'm assuming the one option contract, if you lose the entire thing, you would still be about break even or lose a little bit or make a little bit on the trade. So house money is free money, money that once you have taken all of the profits off the table, this particular thing, if it goes up, awesome. And if it went totally to zero, you would still make money on the trade. A lot of people out there call this a runner or a lottery ticket. I don't really care what you call it, but you guys get the idea of what house money is. That is truthfully my definition of day trading weekly options. If you are buying an option, you need to be day trading it. If you're buying a weekly option, you should only hold a weekly option overnight if you have, or if it has more than 1 week to expiration and you're playing with house money. So at this point, I kind of think you guys get the understanding of what exactly that means. Now, I prefer to sell weekly options. I sell weekly options all the time. In fact, every Wednesday, if you ever get a chance to go to a really cool website, it's called reallifetrading.com. And you can hop over here to where it says the live trading room, click on the live trading room. And every single Wednesday, this goober right here, which is me, the guy with the big head, we do what's called Weeklies Wednesday. So we go out and we actually look for option selling strategies that expire the Friday of that week and get anywhere between 4 and 10% ROI for the week. And of course, you can also come up here to articles, and you can come over here to where it says Real Life Day Trading Journal. Click on that little guy right there, and you'll hop into our actual trades, our setups, and it gives us the profits, losses, all that kind of good stuff. Here's our credit spread journal. So these are a good track of what we do every single Wednesday. It's a Weeklies Wednesday on the trading floor, and just Wednesday by itself will easily pay for the trading floor and make it at risk. You can see that we've had 8 trades, in the month of February on Weeklies Wednesday, and we have lost 1 and we won the rest, that's the point. Win more than you lose, right? So hopping back over to Apple. Usually when I do options on weeklies, I'm selling them. But let's say again that you're not. Let's say that you are day trading weekly options. Well, when you're day trading weekly options, the most important thing to do is to learn how to day trade. I know that sounds kind of self-explanatory and kind of counterintuitive, like no duh, Jeremy, I kind of figured that. But truly, you need to learn how to day trade before you are trading weekly options. So what that means is you need to understand gaps, you need to understand sentiment, and most importantly, you need to have a good trading plan. So if you want help building that and creating that and learning specifically how to day trade, again, you can hop over to a really cool site, reallifetrading.com, click on the day trading portion, and these 4 classes, truth be told, are entirely free, and they teach you, in my opinion, the quickest, simplest way to get in and start learning how to day trade. So understanding gaps. In class 4, I teach you about creating a day trading plan, and that's what's crucial when it comes to day trading options. And here's why, ladies and gentlemen. You ready for this? Day trading options is harder than day trading stock. That's just the truth. Day trading options are harder than day trading stock. Why? Why is that? Well, if you're trading an option, as you guys know, options have something called Greeks. And Greeks are your delta, theta, gamma, vega, rho. You have implied volatility factored in there, which factors into theta a little bit. But Greeks have all of these options have all these Greeks, like implied volatility, delta, and all that jazz. What that means, ladies and gentlemen, is that an option can move irregularly without the stock actually moving at all. So if you buy an option on a stock and it doesn't move in your favor, you actually can lose money even though it hasn't done anything at all because of implied volatility, theta, delta, all that. The Greeks. You can lose money. Weekly options are the most complex thing to trade in the equity world. And they're only complex because of how quickly they move, the ROI potential gain, the ROI potential loss, and all the other things factored into weekly options. You see, stocks, ladies and gentlemen, you just buy them or sell them. There is no special characteristics about them, right? You have to deal with the bid-ask spread, you pay commissions, and you're buying and selling shares. On options, however, there are a lot of other things to factor in. However, with that being said, you can make some serious coin day trading options. So let's just talk about what you would want to do. I think most of you guys are fully aware that I've been bullish on Apple for quite a long time, and all of my videos will give back that up. I've been bullish, especially since this gap back here. Beautiful gap, very, very bullish on Apple. It's a phenomenal gap and go over earnings. Trade right to resistance, pause resistance, and boom, home free. Next target, 133.28, where I expect we hit tomorrow. And then ultimately 142.17. I think it'll take a little bit before we get up there, but regardless, I'm excited about getting up there. So what I'm looking for regarding day trading, if I could just kind of blend it down and break it down into some simple steps, is I'm looking for gaps. I'm looking for something that has an edge to it. Because, ladies and gentlemen, the fact of the matter is gaps, they create and they equal emotion. They give us an edge. They give us a higher probability of being right. They stack the odds in our favor. May the odds be forever in your favor. So if we have the odds in our favor, if we have the momentum, if we have everything going in our direction, that gives us the highest probability of being correct. And that's exactly what we want in all trading, not just day trading. So we go and we look for gaps. Once you look for gaps, you're understandably trying to decipher which type of gap it is. And once you can do that, you can trade it based off of it. So again, we're going to look at Apple today and then one other stock. And Apple today was a retest gap, right? White candle, gapped up, retest gap. Very simple. At an all-time high, ready to go higher, beautiful. So here's the 5-minute chart on Apple today. So depending on how you trade it, you had a few opportunities on Apple, but let's just say hypothetically that you played it off of this little bounce right here, this little pullback into the moving averages. So here are the 10, 20, and 50 exponential moving averages. That's what I use. And what I'm going to do right now is I'm going to explain a few things. I'm about to explain to you how you trade the option and how many you should buy and why. So step 1, find the gap. And in the gap, I like to look for gaps anywhere between 4 and 20%. So if something's moving, if something's gapping, there's some type of emotion, there's some type of edge there. That's what I like to see. Step number 2, discern the gap. Is it a retest gap? Is it a gap and go? Are you waiting? When are you getting in? That type of thing. Then step number 3, once you find your entry, create your plan, mitigate your risk. So on Apple, you see that the stock is trading up higher. It pulls back into the moving average. You get a nice little, new white soldier candle, and you want to go bullish above the high of that candle. Now, again, I know that this is hindsight, ladies and gentlemen, but that's the way that this works, right? In any form of trading that you have, you never know for sure, is the trade going to go against you or is it not? You never know. You just simply have to create a plan, follow the plan, mitigate losses, and that's what makes professional traders professional traders. That's what makes them real life traders, right? They come up with a plan. They're consistent enough to follow a plan because once you become consistent, you become disciplined. And when you become disciplined, you become profitable. So even in day trading, weekly options, swing trading, doesn't matter. That's really the culmination. That is what is the antithesis of becoming a profitable real life trader, is creating a plan and following it. Because we never know what's going to happen on any given trade. So here on Apple, it's a retest gap, trades up, pulls into the 10 exponential moving average and starts to bounce. So your entry is 130.76. Your stop is 130.37. So this is your entry, this is your stop. Once you have your entry, once you have your stop, what do you do now? Well, this is where you come up with your R, right? You already have your R planned. Your R should be in your trading plan, but your R is your risk unit, or how much money you are able to lose on any given trade. And this amount of money should be the exact same amount of money all the time, every time, until you can trade your plan consistently for 3 months. And then in 3 months, if you can trade your plan and you do not deviate your R and you don't break your trading rules, then you can increase your R. It's as a reward. But let's say, for example, your R is 100. What do you do in this scenario? Well, if your R is 100, you do the formula. R equals 100. You take your entry, 130.76. You subtract the stop, 130.37. And you come up with 40 cents. Pretty much. We can just round it and say 40 cents. 39 cents, 40 cents, easy, okay? So if you have a 40-cent stop, what do you do now? Well, you take your R, which is $100. That's how much money you're willing to lose on any given trade. $100, a Benjamin, and you divide out your 40 cents. And that gives you, ladies and gentlemen, what number? That gives you 250, which is the amount of shares that you would buy. 250. Amount of shares. Now remember, I told you that trading stock is easier than trading options when you're day trading. That's just a simple fact. It is. It's easier. Easier math, easier risk reward. I mean, easier calculations. You simply buy and sell. There's nothing else special. Well, here's the deal, ladies and gentlemen. And again, this is just from my personal opinion. I'm positive there are other opinions on this. But the one true nature of options is this. They move sometimes erratically and erroneously. And there is no absolute certain way to guarantee that you make or lose the same amount of money in every single option trade. The best you can do, especially when it comes to weekly options, is get as close as possible. What does that mean? Well, it means that if you're trading a weekly option, if you want to come up with a formula that you can calculate in under a few seconds how many contracts you should buy, you use this exact same formula. Now you can come up with an Excel sheet. You can come up with a formula on how many shares you should buy, delta, theta, implied volatility, how far you expect it to move. You can do all of that, which is totally fine. All I'm saying is, even if you do an Excel sheet, and even if you break it down to the exact decimal point and decimal place, there is still no guaranteed way for you to figure out an exact amount. And the reason I can tell you that for sure is because even in stock trading, every now and then you're going to have a few pennies of slippage. So if you want to get in at 130.76, maybe you got in at 130.77. And if you want to get out at 130.37, maybe get out at 130.35, right? There's always a few pennies of slippage here and there. That's just the way the game works. Okay, Michael Jordan didn't make every shot that he took. But you miss every shot that you don't take. So yes, there's going to be slippage. I get that. But that's why I know that options, there's no absolute, concrete, guaranteed 100% way to know that you're going to lose the exact same amount of money every time. With stocks, you can get very, very close. I would say the high 90 percentile range. 90% of the time, you can almost for certain guarantee, almost to the penny, how much money you're going to lose on any given trade. With options, it's not as easy. So in this example, $100, which is your R, divided by 40 cents, which is your stop, equals 250 shares. That's the amount of shares that you would buy. How many contracts is that? Well, one contract controls 100 shares of stock. So if one contract controls 100 shares, what I often say in weekly options is come up with the amount of shares and you can go up one additional if you want. So what that means is you could do 2 or 3 weekly options. 2 or 3. 2 is fine, 3 is fine. But that's really about all you could do. 2 or 3 weekly options. So on weekly options, if you want to round up, that's oftentimes okay because weekly options, again, they move pretty fiercely. So you can round up. You can round down, you can round up. It really is totally your decision. But, I mean, let's say, for example, it was 498 shares, right? You could do 4 contracts, you could do 5, or you could even do 6. So you can round up a little bit when it comes to weekly options, but you would know when to stop. 4 would be acceptable in this scenario. 5 would have been acceptable in that scenario, 498 shares. But 6 would also be acceptable. But if you start telling me, oh, I bought 7, 8, 9, 10, 11, 12, 50 contracts, no, it's not acceptable. You're not controlling your risk. This is how you control risk with weekly options. So you can round up a little, but don't round up too much because it's going to get very, very close. And I'll explain it to you in true sincerity. In this example up here, if you did two contracts, you would lose a little bit less than 100, probably 65, 70. If you did 3 contracts, you'd probably lose anywhere between $90 and $120. So it's close, right? It's an approximation. That's kind of the best you can do with weekly options. But the good news is, as long as you can create your plan, and as long as you go in and you know what you're doing, you can make money in this. It's just all about you being consistent. You cannot control the market, ladies and gentlemen. You can't control slippage. You can't control how much you're going to make or lose in every scenario. But what you can control is you. You can control you. You can control your trading plan. You can control your emotions, your discipline. You can control you, and that's what's important. So in this scenario, let's say you do 3 contracts. Okay, what next? What would you do? In this scenario, you would buy 3 contracts at the money or 1 strike out of the money on a weekly option. So if you're doing at the money, what that means, ladies and gentlemen, is if you got triggered in at 130.76, you could do a 130 call option, or you could do a 131. 131 is about 25 cents out of the money. That's really my suggestion. Sometimes you could go 2 strikes out of the money, but depending on the stock you're trading, I really don't suggest it that much, because if it doesn't move, you're going to get hit kind of hard by the delta and the theta. Because delta, ladies and gentlemen, just moves more on weekly options. It's just the way it works. So that's my suggestion. If you want to take it, you're more than welcome to. But 3 contracts at the money or 1 strike price out of the money. So in this scenario, what I've done in real life, I would have bought a 131, 3 contracts. If I have a $100 R, 3 contracts at 131 strike. 131 strike. Now what? Well, now it's just simple math from there. Now it's just the day trade. Now it's just exactly what I teach in the day trading course. If our stop is 40 cents, let's take 80, and let's just say that's 131.60 to make math really, really easy in my head. Okay, that's 2R. So 2R, that's 2 times your risk is your target. You get in, you come up to your target, boom. You exit 1 or half of your position. I was going to say 1 contract or half of your position, which would be about, in this scenario, 1. So you exit half your position. You lock in some profit, okay? Take your profit off the table, lock in half, take the stop, move it up to break even, boom. Now you're guaranteed to get a little bit of money on this trade. Okay, 15 minutes goes by, yada, 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 and you end up taking your stop and you raise it up a little bit. You take your stop and you take the stop and you put it to here. And now you're just trailing your stop, ladies and gentlemen. That's all you're doing. It can be an automatic trailing stop. It can be a physical trailing stop. But you just trail a stop, boom. Okay, here's a 5-minute pivot. Here's another 5-minute pivot at 131.83. Here's another one. Here's another one. And so maybe you took the trade all the way to the end of the day. It doesn't matter. But what did you do? Well, that depends on how much time you bought. So 3 contracts at the money or 1 strike out of the money. Now here's what's cool. When buying weekly options, I personally, and you could too, buy the week of expiration. So what does that mean? That means today on Apple, you can buy the week of, and you can do this all the way up to the Friday of expiration. And I'm going to give you some very specific rules in just 1 second. So when buying weekly options, I personally and you too could buy the week of expiration. So that means today, this is February 23rd, the week of February 23rd. So you can buy options expiring this week. Buy them, and at the end of the day, what are you doing? Based on the rules I gave you earlier, you're selling. You're going to be selling because you're not going to have house money yet. At least I wouldn't imagine on one trade. So if you bought 2 weeks of expiration, okay, sure. You could have your other option carry over to the next day or however many you exited. That would be up to your plan, right? It's up to what you want to do. But in this situation, I would definitely take some profit off the table at your target. And if you have more than 1 week to expiration and you want to hold overnight, you can. But keep in mind, the chance of you losing everything on that option is definitely more than 10%. There is a probability that if you hold an option overnight, you can lose everything at the end of expiration. It all just depends on how the trade moves. And what I mean by that is, let's say you got into 3 contracts here, you exited 1 contract here, and you're holding 2 contracts, and they expire this Friday. Okay, they expire this Friday. Well, let's say tomorrow Apple gaps down a little bit. It trades down to here, then to here, then to here. Then on Friday it's at 129.15, and you bought a 131. You just lost every single penny of your investment on that trade. You lost it all because it expired out of the money. Now, if you have 2 weeks expiration, sure, you have a little bit of time to work with, and that's why I suggest if you hold a weekly option trade over the night, I would have at least a week of time on that trade. And again, you're going to probably get out that morning or very, very soon. I mean, you're not going to hold that trade super, super long unless it's just really screaming in your favor, which is fine. If that happens, that's great. So bottom line, ladies and gentlemen, that's the rules. That's my guidelines. Is if I'm buying a weekly option, I personally buy the week of expiration. And you can do that all the way up to Friday, the day of expiration. Buy in that same day, sell that same day. If you want to buy the next Friday expiration, you absolutely can. But it's all about learning how to control your risk and understanding how much you're going to lose on trade and sticking to that particular plan. Okay? So let's talk about two additional things. And that's just going to be about selling options. Now, selling weekly options is kind of the exact opposite, right? Selling options kind of come down very simple. When selling options, if they have less than 2 weeks of expiration, that's the best time to sell. And here's a simple truth. Sell as far away from the stock value as possible. Your goal ROI is 4 to 17% for less than 2 weeks of time. No, 4 is a little low. 4 is kind of for my weekly options. I would say your goal ROI is probably 8 to 17% for less than 2 weeks of time. Less than 1 week of time, 1 week of time, and you're looking at somewhere between 5 and 10% is a pretty decent range. So that's really, when selling options, that's the highest probable scenario is sell them as far away as possible. I'll go over and give you an example. Here's FAS. And FAS just the other day, which was Friday, we got into the analysis of a 119, 118 February week 4 bull put spread. 10-cent limit, which did get filled. Now notice, right, I have right here, we'll not even look at this spread unless we close below 123 on the hourly. Well, here's the hourly chart. Boom. Pulling up the hourly. And you'll notice today we never closed below 123. So I never even looked at the stock, never even looked at the spread, wasn't even concerned about it. So 119, 118 is pretty far away. Notice where it is, right? This is a weekly option expiring now in 4 days' time. So as of Friday, it was exactly 1 week. And let's say Friday, it was at a 126. So this was 7 points out of the money on FAS. 7 points. Just kind of give you an expectation that there are stocks that you can get far away on. And that's just, this is one of them. So that's kind of a good rule of thumb for selling options and buying options is you can buy the week of expiration and you just simply create your plan and don't hold overnight unless you have more than 2 weeks. It really is that simple. Now here is one other very important thing that a lot of people do not know when it comes to weekly options, and this is something that most people don't tell you because most people don't know. When day trading weekly options, the best stocks to choose are within $50 to $200. That's a huge Newsome nugget. That sounds weird. When day trading weekly options, the best stocks to choose are within the $50 to $200 range. A lot of people think a little bit inversely. They think to themselves, oh, well, if I do a $20 stock, I can buy more options. Yes, but the problem with those particular options on $20 stocks and $10 stocks is the strike prices are kind of far away from each other. The delta doesn't move as much because the stock usually doesn't move as much as far as the daily range is concerned. And that's really what you want on weekly options. You want a good daily range movement. So if I could just go ahead and give you right now my favorite stocks to trade weekly options on with an R less than 200. So if your R is less than $200, you know who you are. These are the stocks that I suggest and would just go ahead and recommend that you kind of keep a really good eye on. Apple for sure. Apple's a good one. I like Apple. I trade it often. It's probably just truly one of my favorite stocks to trade. It's great for weekly options. It moves well. I'm a big fan. Let me go actually see what price range Las Vegas Sands in, because Las Vegas Sands, yep, that's another one. I like Las Vegas Sands. Give me 1 second. So here we go. So Apple, Las Vegas Sands. Let's just kind of look at this one today. So today, Las Vegas Sands had an okay gap down. It was decent. Wasn't amazing, but it was decent. A gap down. This was a retest gap. Okay, retest gap, 5-minute time frame. You'd be looking for a retest and for a failure. Here you go. You have a few of them. All right, so here's one and here's one. Both of those are retests and both of them worked. Which one would you probably have taken? Probably this one, right? You can see that little support right there. Approximately 59 gets taken out. So you would have gone short. So you would have gone short approximately at 58 and some change. There's your trigger, 58.85. Here is the stop. Would have been, at the highest, the stop would have been 59.22. I could easily see an argument for a stop at 59.11. Okay, so let's go ahead and calculate this. So here's your stop. There we go, 59.11. So let's do the math on that. That's about 15.11, 26 cents. 26 cents. So you have an R. Let's say your R equals 100. R divided by 26 cents equals, how many shares? I think it's 250. 100 divided by 26 cents. Oh, I was wrong. 384. Okay, 384 shares. So if it's 384 shares, how many contracts is that? 3 or 4, most 5. Do you guys get how I'm doing that math? 3 is the round down, 4 is the most obvious round up, and then the most you would do is one more round, which would be 5. 5 weekly options on Las Vegas Sands. Let's just go in and show you the weekly chart. So here we are over here. So if we go to Las Vegas Sands, oops, I'm sorry. LVS, Las Vegas Sands, come into the option chain, February. And so you'll be at the money. So you'll be looking at a 50. So this one's probably a 59. It's probably what you would have gone with. Let's come back to here. Yeah. So you would have gone with a 59, which is at the money. 59, one strike price out of the money would have been 58.50. So those are the strike prices you'd have chosen, either 59 or 58.50. And again, you come up with your target the exact same way, ladies and gentlemen. You have your entry, your stop, and you go, okay, what's my 2R? What's my double target? So in that scenario, it would be about 50 cents. So let's just say 30. So it might have reached it. Let's say here's your 2R target. Okay, what did you do? Well, if you bought 5 contracts, you would have exited 3 at your target, locked in your profit, and then you probably would have gotten, at some point, you'd have trailed your stop down, boom, 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 and you'd have gotten trailed out around here on the option. And, when you do get trailed out on options, the ironic thing is when an option goes the opposite direction that you want to go, even if you are profitable, sometimes still it can burn you. The implied volatility, the delta, sometimes it can still get you, which is just unfortunate with options. That's why I would truly recommend, if you want to learn how to day trade and you don't have a lot of money, so if you have, let's just say $5,000 or less, and you want to day trade, I'm assuming why you're day trading with options, I would learn how to prop trade. Because if you can't profitably day trade options, you shouldn't start there, right? If you've never done it, you should probably start day trading stock first and then get into options. And really, there's no excuse. If you have a small account, you can just do a proprietary trading. I mean, you can open up a proprietary trading with $3,000, $2,500, $2,000, and if you have a special case scenario, maybe even less. So there's no real excuse to not have a prop account. Because if you're day trading options just because of that reason, then you should really consider day trading stock. Because again, truly, if you got into this trade, right, going in your favor, everything is good, boom, you exit some of your position here, and then the trade comes out and you get stopped out, that stop right there will hurt you a little bit more than you think. Because the implied volatility of that put might get sucked out. You can see the volume is really, really picking up. Maybe the market maker decreases the implied volatility of that put, so you don't make as much money as you numerically think you should have when you get stopped out. Ladies and gentlemen, that's just the inconvenience of trading with options and day trading them, right? They work great, but every now and then there are caveats to them. Okay. So anyway, back to my list. Apple, number one for sure. Las Vegas Sands, I'm a big fan. Tesla, love day trading Tesla. It's great. Great for day trading. SPY, no brainer. QQQ, easy all day. Right? Those are really kind of my top 5. I do like trading Las Vegas Sands a lot. Alibaba is definitely one of them. Yahoo, depending on the day, can be great. GoPro, Twitter, and MU. MU's not quite in the $50 range, but it's so highly traded. But this is kind of my list. And this is kind of me digging for gold right here, these last 4. But these guys, Apple, Las Vegas Sands, Tesla, SPY, QQQ, BABA, I mean, all the time. SPY and Apple, very often. I mean, if I'm day trading an option, I'm going to those 2 things first to see what's gapping and what's not. And if those 2 are gapping, great. If they're not, no big deal. I'll go and find something else, right? You can go to the barchart.com /stocks/gapup.php, and you can search by volume, and you can find, okay, here's Apple, and here's VRX. Today on VRX, made about an hour and a half. So let's just do one more. Here's VRX. VRX, and the entry was here, bullish, about 197.18. Stop was approximately here, 196.19. So it's about $1 of risk. So if you had $200 R with $1 risk, that's 2 call options, approximately. And you'd have exit at the end of the day. And with an option trade, because of volatility and the bid-ask spread and the fluctuations, you really, really want to keep an eye on your bid-ask spread. I truly do not recommend day trading a stock that you've never traded before with options. Let me say that once again. I do not recommend day trading a stock that you've never day traded before with weekly options. Because bid-ask spread, open interest, volatility, all of that can play a factor. If you're day trading options, the biggest recommendation that I can make, and hopefully probably your biggest takeaway from this entire session, is find 5 stocks plus 1 every day that you're watching to day trade an option on. And those 5 are Apple, SPY, QQQ, maybe 1 or 2 that you like a lot. And this other 1 is a stock that you know of that is gapping on that day. So Netflix, Amazon, FedEx, UPS, Walmart, something like that. So these are the 5 that you're watching every single day. You can choose the 5, but I do suggest that you choose an obvious company, the Apples of the world or the Amazons or Netflix. Something with options and something that has a little bit of price to it, right? $50 to $200. $200 and above is fine, but you want to have at that point a little bit bigger of an R. Okay? So if you have a $200 R or less, I suggest something between $50 and $200. If it's above $200 stock, you should have above a $200 R, in my opinion. Okay, so 5 stocks, that's the same stocks that you look at every day, Monday through Monday. Your birthday, your mom's birthday, Jesus' birthday. 5 stocks, Monday through Monday. Those are the stocks that you're watching every day to look at how it's gapping, how it's moving. If it's gapping, if it's not, you're not trading. If it is, if it's moving, you're trading it. And you can trade it with a weekly option because you know how it works. Okay, the plus 1 is if you can find that 1 stock, that 1 company that you know of, you're familiar with, you've traded it before, you know how it works, that's gapping on that day that's special. Again, Walmart, FedEx, Netflix, Google, Tesla, whatever it might be. And ladies and gentlemen, that's really my take on day trading weekly options. I hopefully this was helpful. One of the best ways if you are a brand new trader, and I just truly encourage you on this, is if you've never traded a weekly option before or you want to learn to day trade, just find a real life professional trader who does this and, get them to mentor you. We do have a trading floor that's open to the world, and, this is just a harmless endorsement, but it's the truth. If you want to find someone to mentor you or help guide you through these uncertain waters, just sign up for a trading room. It doesn't have to be mine, okay? You can sign up for whoever you want. It doesn't bother me. But get someone to mentor you. And a lot of these trading floors, guys, ours is probably one of the most reasonable out there in the market. It's only $99 a month for the afternoon room, $149 for both the morning and the afternoon. But take that in mind and understand that even if you go to another trading room and you spend $300 a month, that's much less than you might end up losing if you do not know what you're doing. Think about it as an R unit. right? If you have a $100 R, you literally are risking one trade to sign up for the trading room, and that way you can get guided and mentored and handheld through an entire month of analysis and data for $100. And in my opinion, it's a no-brainer. That's how I learned how to trade often. I mean, I went into all kinds of trading floors at the beginning, and I knew how I wanted to make one. I knew exactly how I wanted it to be. I knew I wanted it to be fun, entertaining, exciting, energetic, a little quirky, but also, full of stock information, trading, and analysis as well. So regardless, ladies and gentlemen, I appreciate you watching the video. If you have any questions, feel free to reach out to me, Jerremy at reallifetrading.com, and I'll be more than thrilled to help answer any questions I can. And until I get an email from you or until the next video, thank you so much for watching, and remember, love life, live life, and trade it. Welcome to Real Life Trading.